Well, thanks for being on here,
I
Brandon.
appreciate
Yeah.
that.
Yeah. So, Brandon Snyder.
Yes.
And do you remember how we met?
I don't know specifically. It's been over a decade. I
Yeah.
do know that.
Yeah.
So
It's, I thought back and my connection to you, I think, was Casey Glinga Smith.
yes.
And he had you come into a meeting one time at Keller Williams.
Mhm.
And I think the topic we were talking about, I wanted to set up an LLC or do something.
Yeah, it was kind of like getting real estate
Yeah,
agents,
getting your
kind of
feet wet with that kind of stuff. And
entity
so,
ownership and retirement
yes.
planning, stuff like that.
And
Yeah.
there was a little thing that, you were just collecting information. So I filled it out. And so it was just the perfect timing for me wanting more information. You reached out to me. And
Yeah.
so that's where all of that started.
Yeah, I think that was longer than 10 years ago because I mean, I bet that was closer, 10 or 11 years ago.
Well, yeah, I started there in 14. So it would have been somewhere
Yeah,
between
because I
that
mean, I
time.
started in 14 as well, 13,
Okay.
14. So I can't believe, no, I started in 12,
Okay.
2012. And then we went independent almost 3 years ago now.
Okay.
And so completely different scenario or
Yeah.
situation. It's a lot different now.
Are you like did you study finance or what's your background?
Yeah. So, I mean, I went to Lubbock Christian. I did not graduate. I studied economics
Okay.
at Lubbock Christian and then started my first business when I was 19 years old.
Okay.
My dad had a sign company and I started a print shop with him
Okay.
for printing t-shirts and then got into doing mobile advertising on like
Mhm.
the city bus contracts. And I did that for a little while, grew that to a national media company and sold a chunk off of it to a major media company. And so we did a lot of billboards and transit, and I still own the world's largest movable display still to this day, 25
Really?
years later. Yeah. It stands 6 stories tall, and we've taken it to the Grammys, the Red Bull Air Race, the Super Bowl. We've done
Mhm.
some pretty cool stuff with it. And so I've had a media background. So I really came to finance in the most natural way possible,
Yeah.
being not even associated with it. But
Yeah.
when I was in that media company, and it was an out-of-home advertising agency, and then it morphed into more of a event marketing or media agency called Dark Puppet. And we took displays and we traveled all over to events. But as you can imagine, in the event world, you're really, really busy, Wednesday through Sunday, and then you're kind of dead Monday, Tuesday.
Yeah.
And so I'd travel back, and I really, I'm very analytical. And so my mom was an accountant, or is an accountant. And so I kind of have that natural, I gravitate towards the numbers kind of
Yeah.
thing. And so I started day trading actually. And then I was here and we had our second kid, and I was really traveling 30, 35 weeks out of the year.
Mhm.
And with having a newborn, a second one, Jen was like, man, you got to be home a little bit more. And I
Yeah.
got tired of traveling. And I got a weird email that same week from a guy at a big insurance and wealth management firm that says, hey, I kind of followed you and want to visit with you. And I was like, I'm never selling insurance and blah, blah, blah. Right. And so I went in, had a conversation. He was like, you have no idea what you don't know. Right. And so we figured out that through there that insurance is a huge instrumented tool for higher net worth people to mitigate taxes, but also for estate planning purposes. And so really fell in love with it. I ended up, stayed with them for 12 years. Ended up being 52 out of 16,000 advisors across the country when I went independent. And it really came down to the way their business model was structured
Yeah.
was mainly keep everything a part of the conglomerate
That
insurance company.
particular, yeah.
And I wanted more fiduciary independence of saying I could do everything. I don't
Diversification.
need, and I don't need to sell a product to you.
Right.
I wanted to be able to sit down and just say, what does a family or a business owner need? And then align their goals and their wants to what the right situation and be a fiduciary financial planner. And that's what I ended up being. And I learned really quick. I just, the Lord kind of takes you in a certain path. And I got aligned with some of the best retirement plan specialists in the country. And they were out of Boston and worked with them a little bit. And then a guy in Austin, Texas, probably one of the top 10 financial planners in the country. And I still work with him to this day. And he's one of my closest business friends and for about 12 years now. And we just kind of morphed it. And so, I think any good business, you just find great people
Yeah, for
to
sure.
put yourself around him. We were talking about,
Yeah.
Brian Starr, which
Yes.
is Dr. Brian Starr. He's got a PhD in
Yeah.
economics. He ran Lubbock Christian University's
Mhm.
economics department for a
Very
long,
well respected.
very well respected. Now, he's at Oklahoma Christian and he's a provost there, but he runs our investment committees. And on our wealth management side, we have financial analysts that are tied in with him. So you get an economist and then you get a financial analyst, and those two combinations are
Yeah.
really, really good at building wealth management models. And I peek my head in there and tell everybody I'm the dumbest guy in the room,
Right.
but it's a lot of fun playing with those
Yeah.
guys. And then on the other side of that is I'm fortunate. A lot of people don't know this, but Texas Tech University is one of the top, if not the top, financial planning schools in the country.
Really?
Yeah, they're actually number one.
Wow. I
And
did not know
so
that.
I got lucky one day where I was looking for a paraplanner, walked in, and this kid walked in, and he's worked at two national firms, and he wanted a career path, and so I brought in a CFP to work our financial planning side, and we just keep on growing that side of it.
Yeah.
And so fast forward when we went independent, now we have tax attorneys and staff, we have valuation analysts on staff, and we really gear towards a lot of business owners, but a lot of families. And so our late relationship inside there, I've, pushed some clients over the years to
Mhm.
financing over at Texas Tech Credit Union over here,
Mhm.
but there's so many possibilities for businesses
Yeah.
and really individuals and the owners or executives inside of business to
Yeah.
understand wealth. So that's kind of how I got started, and I've been fortunate just to
Yeah.
play along in that space a little bit.
Well, so, I mean, how you got started was not at all what I was expecting to hear. I just figured you went to college and this is what you got a degree in this. And then you kind of, I mean, you have a little bit of a different background.
Yeah, it is. It's funny. And that guy in Austin that's like literally probably one of the best financial planners, he was an electrician by trade.
Really?
And you will find that more and more. I think the common denominators is I don't look for degrees or designations,
Right.
even though we have a lot of those guys on our team. I kind of like that PhD concepts. I want people that are passionate, driven, and hungry
Right.
to be. And so you can find that in a lot of different ways. And so my ability is I like to get really smart people that are very technically inept on what their profession is and
Right.
bring them on to us, but then also be able to communicate. And I would say 50% of guys that are in our industry don't have a direct finance background.
Yeah.
And there's certain things that you have to be able to do. Like, I mean, I'm probably more through 15 years, close to 15 years of doing this. I probably understand more economics and financial analysis than most people do.
Right.
But there's some guys that are, I mean, the CFA designation, which is the Chartered Financial Analyst designation, is probably the hardest, if not one of the hardest. I mean, it's right up there getting a law degree. It
Yeah.
is very, very difficult. Is one of the most impressive designations to get. But I've found a lot of those guys, and I have a couple of them in my shop that, and three of them over the years, that they know the academic side of it, but the real world situation is it takes a long time. It takes, I feel like I know a smidgen of what the entire financial world
Yeah.
is because it's so complex.
Yes. And it's constantly changing.
Constantly changing. I mean,
Yeah.
you're looking at it right now. You got cryptocurrency that's really taken over fiat currencies and how those things are affecting it. And so there's a lot of things that are changing in our societies today and how money it's very fungible and how it
Yeah.
moves around.
Yeah. Yeah. No, and I mean, I have a degree in psychology. And
Right.
so, I mean, in which I don't even need a degree for what I do.
Sure.
But it's like you said, I mean, it's really when you start getting into the meat of what you're doing and the passion and it's the hands-on knowledge and learning
Mhm.
all those things. That's what makes you good at what you're doing, not the actual degree.
Yeah, it doesn't. It helps,
Sure.
right? But we have nicknames for CFPs too that are not as polite. But I think that it just shows that your competence,
Right.
right?
Yes.
And
And the ability to finish something and yeah.
things like that. And so I look for a lot of the guys in our MySpace that I've actually worked with that are super successful or ones that owns businesses
Yeah.
before. And they understand how free
Right.
cash flow in a business and discount fat cash flows work and all the things that are complex inside
Yeah.
of there. If you understand how business works, you can translate it over to publicly traded companies. You can translate it over to private equity. So there's all these ways that you can analyze it. And it really comes from the school of hard knocks. And I still learn that what's cool about what I do is wake up and I sit down with either clients that are very sophisticated and some very, very simple, right? But I learn a little bit from them too. And
Yeah.
so when you've done this for 1,000, business owners and clients, everybody's got a unique story and how they created wealth.
Right.
And I get to glean into that aspect of, oh, this is how you did it, right?
Yeah.
And so one of our great elite advisors that's on our team now, because we're in a phase where we're buying other firms. And so we bought a firm in Wichita Falls, and one of his big clients this year was a very prominent YouTube social media, um, what do you call it? Creator, I guess is
Yeah.
what it is, right?
Influencer. Yeah.
Influencer, yeah. And I mean, making millions of dollars at
Yeah.
26 years old.
Wow.
And so you get to see all those cool things.
Hmm.
And so I'm always prying them going like, how are you doing these things? Cause I think you see it from, just podcasting alone.
Yeah.
It's I think the culture of currency now is a lot of people are just paying attention
Right.
or getting attracting audiences is now a very valuable asset
Yeah.
class that people are starting to glean into as well.
For sure. Well, as you kind of talk about that, that kind of segue a little bit into one thing I wanted to talk about. Um, yeah. So right now, I mean, I feel like people are just looking and trying to learn things and trying to understand. There's a lot of people out there struggling right now, just financially,
Hmm.
and we are in um, a very sensitive time right now
Yeah.
with post election.
Hmm.
And I mean, the way I kind of see it at the end of the day, it's not about political affiliation. It just is what it is.
Sure.
And people are struggling.
Yeah.
And how do you, like, as a financial planner, I mean, I'd love to talk about the economics of it,
Hmm.
of where we're at, but also then just like, how do you help people from where your vantage point is to help them financially? I mean, I kind of feel like that the normal person can look at someone like you and say, "Well, I'm just trying to pay my bills."
Yeah.
And so how does someone ever get to a point where maybe they want to invest, but they're just struggling to pay their bills right now? Like, what do you say to that person?
Yeah, so some of it's like I'm not a huge Dave Ramsey guy, but he's got some valid points, and I think when you're talking to the masses of where Americans are, I think you really need to look at like what's important to you, and as soon as you figure that out, and I come into every one of those meetings where you don't know what you're walking into when you sit down, which makes it fun for
Yeah,
me, right? And so, but it's also one of those sensitive. I don't trust you. I don't know if I want to disclose all of my information to you, right? All these things, and it's kind of like the psychology side of it, and we call it behavioral economics, right? Of trying to understand where people are in the season of life that they're in, and how you can actually mirror that to making sure that you don't overwhelm them, but
right.
at the same time they get value from it. So the easiest way to answer this question is it all depends, and that's such a cop out thing, right? And so the easiest way to do it is just take a really long look at what I always don't look at where I'm at today. I want to look at where I want to be.
Yeah,
And so because if you don't have that path forward
right.
to make tomorrow better than today and today better than yesterday, if you don't have that part of finance, then you're never gonna, no matter how great the plan is, you're never gonna adhere to it.
Yeah,
You might do it for 3 months, 6 months, but then life stops being fun. You can't
right.
eat out as much and all those things. So you have to create the vision. I think that's the biggest part of what we do as financial planners. And this is why retail investors don't do as well as when they work with professionals, because it keeps them on track. Sometimes it's not teaching them something new. It's just renewing their mind to what they
Right.
already know and holding them accountable to it.
Yeah.
And so I think that's a key part of financial planning inside of it. And then it's just all math at that point in time, right?
Yeah.
So do you value the Starbucks drink more than your retirement? And when you start delineating between what I value and you ask those deep penetrating questions, or like, where do you want to be? Do you want to continue to do the rat race you want to do for the next 25 years? Or do you want to do something different? And sometimes it is, hey, let's tighten our belt. That usually doesn't work that great. Or it's get out of debt or accomplish these things. But then the second part of that is trying to understand what's achievable and not making it over. I don't really focus on a 20, 25 year financial plan. We
Hmm.
have those conversations so we know what the end goal is, right? But we really need to focus on the monthly, quarterly, annual milestones, what we call narratives
Yeah.
that we're accomplishing with a client. And that's more important than the long-term deals. Because the funny thing is I sat down with a huge, wealthy person, right? And he had a little model airplane on his desk and well, yeah. And when you're kind of that, and he's an oil guy,
Mhm.
right? And when you're kind of that wealthy, you have that model airplane, but you actually have the real one in the hangar.
Right. Yeah.
Does that make sense?
Yeah.
And I asked him, and we had that conversation because I got my pilot's license when I was 16, and so I was like, "Hey, man, why do you like that?" And it was a $30 million jet. And he goes, "I go, do you regret buying it?" And I said, he goes, "I don't, because I did it respectfully. I did it honoring. I did it within my means, and I did it for a purpose of both enjoyment of buying back my time, and then also being able to increase and grow my company." So he did it the right way, right?
Right.
But then he said something that was very stark, and it stuck with me. And he goes, "Brandon, just because I've got a $30 million plan doesn't mean I don't want that $50 million plan." And he spins around his monitor on his desk and he goes, "Check this one out." And it's like newer, it's a little bit bigger, it's nicer, and it had all these cool things to it. And I was like, wow, that. So I walked away from it. So even if you set up a goal today and it went from 10 years and 20 year or 30 year from now, you're going to change it anyways,
Right. Yeah.
right? And so it's good to have that goal of like, hey, I feel like this is what success is for me, and this is really what rich and wealth is, because everybody has a different definition of it.
Right.
It's an abstract term, and so it's okay to have those, but I need to be able to get you month over month, quarter over quarter, to be within the budget you need, save what you want to do, and be able to expand your horizon and your vision of what you want for
Yeah.
yourself and your family, right? And everybody's a little bit different. Some people, it's just, I want to retire from the 8 to 5 job and start my own business. Right. And then you got some people that are like, I have all these other assets that I inherited, or I don't know how to protect my family with the right insurance. Right. And they just want somebody to hear them out and go, let's look at all the options
Yeah.
and see which ones fit.
Yeah.
So that's the one side.
Yeah.
Now, I know that was a long explanation, but it's a really tough one to just try to understand how to help people. The other side of that is the geoeconomic conditions that we're in today.
Well, and hold on, I'm going to go back to this. I do want to say that because I've probably spent, 3 to 4 hours with you
Mhm.
sitting and talking about
Mhm.
finances. And there is a level of intimidation
Mhm.
that I'm like, I don't know you. And I'm like putting all this out here
Yeah.
and all the dumb things I've done. And
Yeah.
at the same time,
It's almost
though,
like going to a therapist, isn't
yeah,
it?
it is. But at the same time, I will say, as a testament to you, is I feel like you looked at that and I never once felt judged, because it's just, well, it is what it is. Okay, so what are we going to do to fix that?
Yep.
And you did. You kind of went through, okay, what are your goals and how are we going to get there? And I feel like you kind of take the bite-sized piece approach, because yeah, if you're looking at this whole long term, that's overwhelming.
It's overwhelming, and the vision gets so far out there, you'll take instant gratification
Right.
because we live in that society now
Right.
over a long-term
Right.
value, right? So most people can't wait 2 years to go get a new car,
Right.
right? Now you're going to try to wait 20 years to
Yeah.
retire. And so it's a very hard concept to wrap your head around. And some people are way better
Yeah.
at savings than other people are, right? And it's just the way the human nature is. So
Yeah.
it's different in there, but I appreciate the compliment
Yeah.
on that.
Yeah.
I try, there's never judgment in it. I always look at it like, um, it, it's like a puzzle piece that I'm trying to solve.
Yeah.
Does that make sense? That's
Mhm.
what makes it fun for me, because I mean, we know 5,000 different planning strategies out there. So it really makes no point for me to tell you all the ones that are irrelevant to your
Yeah.
current situation. I'm just trying to move you a little bit closer to what your goal is.
Yeah.
And what you're passionate about.
Well, and that makes sense. It's kind of the same way for me. I mean, I feel like what I do all day is do puzzles too.
Yeah, right?
It's like, if you come to me,
100%.
you want to buy this house and you want to put this much money down. I'm not questioning, should you put more money down? I mean, people will ask you, do you think this is smart? And I'm
Mm.
like, well, I mean, what's your goal?
Yeah,
And so it's
do
all
the pros and
about
cons and
exactly
scenario
like,
planning and all that other
what are we
stuff.
doing here? How do we get there?
Mhm.
But a lot of people think like I sit around and look at their bank statements all day to see what they spend their money on. I'm like, no. Like,
Yeah.
I'm making sure you have enough money that I can
Yeah.
source your down payment. But I
Yeah.
don't care what you spend your money on.
And it's funny though, and I would say I have a fault because I like to educate, and so
Right.
I go into the analytical side of it a little too much. Like what you're talking about is debt to income service coverage ratios, and in business we call it debt to
Yeah.
service coverage ratio.
Yeah.
Y'all call it the debt to income,
Debt to
don't you?
income
Yeah.
ratio. Yeah.
And so on the personal side of it, so that's where I really geek out.
Yeah.
Does that make sense? Because
Yeah.
if I can actually find a little bit of more money here, I can change this number, and I can show them how it really adds value to their
Right.
life. Is
Yeah.
what's fun about it. And then some people just don't see that. Can I do it or can I not? They just
Yeah.
want the light switch on or off. They just want to know what the answer is. Some people want to know what the process is, and so you have to identify that early on in
Yeah.
relationships to build trust. And trust is not built over a meeting. Trust is built, I find, over the execution on the behind the meeting.
Yeah, for
And
sure.
so it's like, hey, we're going to go do this. And then did it get done the efficient, right? Was it communicated to me in the right way? Was there any picadillos in there that wasn't communicated to me? Those are the things that you have to, I always try, probably over, is try to make sure that I explain every single upside. And if
Yeah.
everybody only gives you the upside and they never give you the downside in planning,
Yeah.
especially with finance, they're trying to sell you something,
Yeah.
right? They're trying to earn a commission or something like that. So I always try to give that balanced approach the best I
Yeah.
possibly can.
Yeah. Well, I think you've done a good job of that for me
Good. I
for me to
appreciate
see that.
that.
Yeah. Okay, so let's go back to the economics now.
Ah,
Okay.
yeah.
So, okay, yeah, here's one thing that I've noticed so far on our side, and you kind of tell me what you're
Hmm.
seeing is, but there's been, we haven't seen a ton of change in interest rates,
Hmm.
and typically, history shows that typically we will see interest rates change in an election year.
Hmm.
This year, there was a lot of speculation that if Trump won,
Yeah.
that interest rates would start to come down after the
Yeah.
election. If he didn't win, they were just going to go way up after the election. That's kind of what the speculation in our world was. Where
Yeah.
we're at right now, though, is we're seeing that, like yesterday was the market opened up good.
Hmm.
And a lot of that seems to be with who Trump is choosing to put in different positions, right?
Yep.
Um, but now we have seen where the Mortgage Bankers Association and let's see who else, Fannie Mae, they're starting to already change the interest rate predictions for 2025. And they're perhaps saying they're not going to be as low as maybe they thought they would be. So a
Hmm.
lot of things are kind of changing right now.
Yeah.
Let's just talk about like I said, and to me, it just is what it is. I mean, whether whoever you voted for doesn't matter to me. I don't care.
No, we're just talking about the facts of
Yeah,
what the
just the
rates are and
facts
what
of it.
history is.
Yeah.
And this is where like the history side of it really is a lot of fun. So you got to look at where the Fed's in a very, very, and a lot of people don't understand there's just two departments to the finance, right? You got the
Mhm.
Fed side, which the Fed controls interest rates, and
Right.
then you got the Treasury side, which prints the money for the bonds. And so we need to unwind a little bit back 2 or 3 years ago and really understand that when COVID happened, however that plays out, we printed, more than $7 trillion worth of fiat currency of the United States dollar.
Yeah.
And when you print that kind of money, you're going to create inflation. And we did. We had massive inflation, right? Inflation.
Did they know? I mean, did anyone think about, okay, what's going to happen if we do this? Was that ever a thought process, do you think?
Yes, it was. And the idea behind it, Dr. Starr's really good at this, is that the US is so good at growth that we can grow ourselves out of the
Out of it.
inflation,
Yeah.
right? However, I do believe that our politicians no longer have, in the broad sense, the best interest of its citizens anymore.
Yeah.
And so I think, shutting down for 15 days was a realistic thing to do at the time. Turning that into 6 months or a year and giving billions and billions, trillions of dollars worth of stimulus to just everybody on the planet was not, the current deal. And then kind of it's been snowballing since then, right?
Right.
And so now, so you got to pay the piper eventually. And so what's ended up happening is you had transitory inflation, which was, as of this podcast this weekend, we're on a Tuesday. Treasury Secretary Yellen just resigned
Yeah.
inside of there. And so she was over there that said transitory inflation when all the lockdowns were and goods and services weren't moving during COVID, created the inflation, and that it was only going to be a short period of time. It ended up being an ongoing normal inflationary
Right.
bent, And so the only way for the Fed to offset their mandate of lowering inflation was to raise rates. And so that put us in the position where we went from 0.25% on the Fed rate to 5.25%.
Mm-hmm.
And so it was 5% rate in 2 years. And we had a lot of things that nobody's ever seen before, or at least not in the last 25 to 50 years, right? They've seen it before, but we haven't in our lifetime, is really seeing that a lot of banks held long-term treasury paper that were on the balance sheets that were, at a very low rate, and they were trying to squeeze those margins. And now they're holding a whole lot of paper that at 5.5 and these 30 years treasuries are at 2.5 aren't worth what they were. And so we saw a massive loss in the bond market in the last 2 years.
Yeah.
And so the only way to get that back is to lower rates, which kind of takes us to where we're at today. And so now you have to look at it like, okay, so what cycle are we at? And so my biggest concern and fear was when Trump was winning. I thought Trump was going to win hands down. I
You
didn't
did or didn't?
I did. I
Okay.
did. I
Yeah.
really did. I thought there's no way that and then you got, he had a team around him from Vivek. I'm a huge Vivek fan just personally here. And I liked some Democrats out there as
Sure.
well,
Yeah.
right? So I'm more slanted because of fiscal responsibility
Right.
to being more on the Republican side and just being transparent here. But I thought he was going to win the House and the Senate, and then he was going to lose the Congress. And I was like, that's hooray. So us in finance, we don't like it with any party gets all three branches because they can steamroll
Right.
law changes to the degree where it disrupts business.
Right.
And so that was kind of like we thought a very low percentage that he was going to win all three. Am I glad? Yeah, kind of glad he won it. But that means that we're going to have challenges ahead of us. And those challenges is, are they going to lower rates? And are we going to create stagflation, which is the worst type of inflation that you can get? And there's
So what does that mean?
so there's some probability it's going to happen, and we'll come back to that real
Okay.
quick because that's a huge
Okay.
conversation. Okay, so right now the Fed has said that they're going to lower rates, and they started 50 basis points or a half a percent, then it was 25%. The December's probably I think it's baked in at like 59% on
Yeah.
the CME data that they're going to lower another, right? And then you might get a pause. And so I don't think you're going to get a pause. What I'm really concerned about, and I wrote a huge paper on this about a month ago, is I was really concerned about the government hiring. They hired like 918,000 employees the month before the election. So we had 4.3% unemployment that drove it down to 4.1. That made it look like the economy is growing, but the private sector was actually laying off. And so you got this weird, like government's the only one hiring, and then the regular public sector is laying everybody off. And just to get through, I felt like it was just to get through the election
Mm.
so that there wouldn't be a talking point on either party to
Right.
say the economy's dropping, right? So now that Trump won, I don't think it's going to be set up in a scenario. And it wasn't my opinion of this. I just think it was the writing on the wall when Yellen just all of a sudden resigned, right? Is that there's going to be a lot of bonds coming due in a very short period of time. They're going to have to renew these in shorter duration bonds at higher rates. And so I have a census that we're going to get lower rates, and it's going to be a lot lower rates. And I'm on the outside looking in. I'm the minority on this. A lot of people think kind of what you're thinking is they're going to lower rates a little bit, and then that's it, right? I think you're going to start seeing economic data that comes out from the JOLTS report, which is the job openings,
Yeah.
right? You're going to start seeing that unwind and unemployment go up again. And then can you kind of feel it though? The consumer just doesn't feel like they have that excess capital that they have.
Oh, for
They're
sure.
spending less, right?
Yeah.
This morning, I think the home sales were down 17%.
Mm-hmm.
I think is what it was this morning. And so month over month. And so we're seeing that now. Is that correlated to the higher interest rates and they're not coming down fast enough? Maybe, right? Probably. And so I think what you're going to get is rates coming down, but they're only going to come down for a short period of time. So I think you're going to get a hard landing is what we call it, and a deeper recession going into 2025.
Really?
Yeah. So look at some of the economic data out there. That's really important to look at. Is the stock market, just from a stock market level, is trading at some of the most unbelievable oversold, overvalued valuations that you've seen. Like in my 15 years doing this, I've never seen valuations this high. And so I'm not a buyer in the stock market right now. I think it's when you start getting irrational buying, and there's stocks out there right now that are trading at 300 times sales.
Yeah.
So a typical company will, a growth company will sell for 4 times sales.
Yeah.
And you're selling for 300 times sales. I mean, that's just an
Something
irrational.
crazy. Yeah.
Yeah. And so everybody's got this, boom kind of up. But if you look at some of the institutional investors like the Warren Buffetts, I mean, he sold 75% of his holdings and he's in cash.
Really?
Yeah. And so and this is coming off of his 15K that he has to report every quarter, right? And so it's a lag here from the last quarter a couple of months ago, but he's gone a lot. So a lot of the institutional guys are starting to take their chips off the table and go into cash. And the retail people are coming in and picking that up for right now. And I just think it's not to be lived. Now, I don't want to sound like I'm a pessimist. I think that actually the U.S. economy is fixing to be one of the biggest booms ever. I
Really?
just think we're going to go through a pretty hard 6 months to 9 months of a hard recession to get there. And so, just take the Department of Efficiency that Trump's putting out there, right?
Yeah.
So let's just assume on face value, there's 19.2, 19.4 million government employees. I know, let your jaw drop on that one along. Like, we don't need 20 million government employees. But let's just take that on at face value that they're going to reduce that. And he's wanting to reduce by 80%. Now,
Wow.
out of the 19 million government employees, not all of them are federal. Some of
Right.
them are state, right? In fact, like 60, 70% of them are state level. So let's just say that he reduces 2 to 4 million employees.
Now, what government employees are they? Like,
Well, I mean, we have 200, I think the number is 286 government agencies now.
okay, we have so much.
So much.
Huge.
And like over half of them overlap each other.
Yeah.
And so I think Vivek really came out and unpacked this. And if you watch some of his speaking, I think there is too much regulations, and it's gotten to the point where they're regulating just to regulate.
Yeah.
And so I think we do need to as a society of citizens, take back a little bit of the control.
Yeah.
I feel like the tail's wagging the dog, and the government has too much control. And that's just me. I think the government needs to be out of 75 to 80% of the stuff that they're in. We've created a society where there's a safety net for everything. And that's not how our ancestors or, the people that started this country ever grew up. You kind of made it on your own merit.
Yeah.
And that's what I think it needs to get back to inside of there. So if you fast forward going towards stagflation's where you're coming with, and that's my greatest concern, because we went through inflation, right? I mean, inflation, holy crap, that was bad. So now imagine going through that same inflation, but unemployment's skyrocketing.
So what does that do then?
Yeah, so the Fed can't do anything, right? So the Fed typically raises interest rates to get inflation to go down. But if you raise interest rates, right, for every 1 point interest rates go up, you got a massive amount of unemployment goes up.
Yeah.
So if you already have massive unemployment, you're at 5% or 4.5%, 5% unemployment, and you start seeing inflation, and our print last month showed a little bit of inflation, and you start getting that double-headed snake there of going high inflation and you got high unemployment, then you're in trouble. And so this is 1970s. And so if you look back 1970, 72 through 76, and we had that lost decade right there, that really the entire economy kind of goes sideways there, because I think the Fed's only option at that point, it would be to raise rates extremely fast, extremely hard, create a deeper recession to get that inflation down, which is going to drive up unemployment even further. So we got to it's kind of like threading a needle right now that the Fed's got to do. And that's concerning.
So let's clarify a little bit here. When you talk about, okay, so typically in a recession, mortgage rates come down.
Mm-hmm.
When you talk about rates, you're talking about the Fed. You're talking more specifically to like.
They're all tied together, but
right. They are. But at the same time, like, I think what people get really confused on, like we have to explain this all the time.
Mm-hmm.
When the Fed comes out and says they're doing a quarter point or half a point basis, Fed funds rate, people think, oh, that means the mortgage rate's coming down.
It's
like,
directly
no,
linear.
It's not exactly the same.
Yeah.
And so
they're correlated, but they're not directly.
Right.
So it's the yield curve is what you're
exactly.
referring to.
Yes.
Yep.
And so like where as far as like in my world, what do you think is going to happen with mortgage interest rates?
I think so. What are you at right now? You're at 6.8,
6.75. Yeah.
And
unconventional.
Unconventional. So I would. We need to break this down in duration, right? So everybody has these conversations, but they don't preference in what time frame. One is none of this is financial advice. This is just us having a conversation, right? So, but second is we need to also look at it like, I think you're going to get rates lower by at least a point and a half by sometime July through the end of next year. Okay.
I'll take that.
Right. However, I think unless Trump's plan does great economic growth and we're not in World War III, I mean, we haven't even touched the wars right now, right?
Yeah.
But if that doesn't happen and we're at a place where we can grow ourselves out of it and we don't get high inflation because a lot of the stuff that he's screaming right now is inflationary,
Yeah,
right? The
it is.
tariffs
Yeah.
and that side. I think he's using it as a mechanism to make global negotiations
Right.
easier.
Yeah.
And so it looks like it's kind of working here. So he threatened 25% tariffs on China. I mean, 10% on China, 25 on Mexico yesterday,
Mhm.
25 on Canada. Mexico already came back and said, "Hey, we've got rid of all the caravans. We're turning them back." And they're going to work on the drug dealing thing. It sounds like so, and it's all just political talk.
Yeah.
We'll see if any of it comes to
Yeah.
merit, but it sounds like it's working a little bit. Let's just hope he doesn't do the tariffs. I
So
find
you
it.
don't think he needs to do the tariffs?
I think he needs to use a very loud microphone and a very soft stick. Does that
Okay.
make sense?
Yeah.
Because tariffs are transitory and all inflationary. Everything it's going to be is just going to create a massive amount of concern. Will it bring jobs back to the U.S.? Yeah, and I think that's where if we have a lot of public sector
Right.
get laid off, those jobs have to go somewhere,
Right.
right? And so I'd like the private sector to pick those up. And if we can manufacture more stuff in the U.S., I think we're always going to be in a better
Yeah.
position. Whether it costs us a little bit more to do it, I'm willing to pay that slight cost. Now, if it gets ridiculous, then we're in problems because we are a global society. I don't care what anybody says.
Yeah.
We rely
For
on
sure.
everybody, and so we just got to make sure everybody plays fairly. And currency manipulation is a big thing with China. Um, along with stealing IP, is a big thing with China. So, but if you look at the stock market today compared to global markets, the United States is extremely overvalued.
Yeah. Yeah.
And AI, we hadn't even talked about AI.
What do you want to talk about it?
AI is going to be, I mean, so that's how we get out of it, I think is what it is.
What? What? I don't. You're gonna have to explain
Yeah.
that.
So I think that's really, so let's just unpack that to the fact that let's say we go into a recession in 2025,
Okay.
a deep one. Okay. And I think it's going to be
And
short and
well,
deep.
hold on. So if we go into a recession, when like what is your kind of timeline for you when you think that might happen?
I think we've been in one.
Well, yeah, and I don't disagree with that. I
Yeah.
feel like we just
But
haven't
the
named
government,
it.
yeah,
Right,
we
they
hadn't
would.
named it.
Right.
Yeah, they quit naming them. They changed the. It's funny how they changed that, but I think we've been in some version of it.
Yeah.
But I actually, where the consumer actually says, "Okay, I'm in a recession," and we start seeing massive layoffs. I think that's probably going to come in that February March time,
Okay.
right? Because it really is going to coincide with him taking office.
Mm-hmm.
I think that's and he's
Kind of
in
a little bit of a lag.
yeah, a lag, but also I think they're setting him up a little bit where they're gonna make it difficult for him to make a lot of changes quickly. And so even some of his appointments to his key offices are going to get a lot of pushback in the Senate. So I think he is well prepared better
Yeah.
than what it is. But making those stark changes that he's talking about, things like Doge, right, and just being efficient inside of the government, he's going to get a lot more pushback. You got to understand, there's trillions of dollars that are passing through the government hands, and they just came out with that study a week ago that the government didn't pass another audit for the DoD. And so, I mean, they missed it by almost 55, 60%. So they couldn't come up with it. It was like $500 billion was misplaced and they can't account for
That's
it.
insane.
And that's not the accurate number, but it's higher than that.
Yeah,
It's
it's
substantial.
ridiculous.
It's like 560, I think. But it's a ridiculous amount of money. So all of those people that's been in power on that side of it, I think are going to come to a rude awakening and being a little more accountability to them on what they're doing inside of it. And so with that happening, we're going to go through just like anything else. When you remodel your house, right? It's not the greatest place to live in for 6 months to a year,
Right.
but the outcome is really, really good. So when we get past that hurdle, I think we're going to get in 2026, 2027. Then look what AI is doing. And so it's very, very interesting that AI is really coming in there and the efficiency on how everything is being used. And so I think you're going to lose some jobs because of that efficiency. But at the same time, I think new jobs are going to be created from
Yeah.
it. And so it's just like the calculator, there's a lot of things that changed on that side of it. So I think that's how we can grow ourselves out of it.
Yeah.
And then the demand of energy is going to increase substantially. And so I see oil, that demand, you've seen that a lot of, I mean, Microsoft just tried to buy, what is it, 3 Mile Island, I think, for $3 to $5 billion to restart the nuclear power plant. I think nuclear's coming back into play. We're going to see that stuff because the demand for energy for AI and machine learning and things like that is going to be well exceed what our normal
Yeah.
output of energy is going to be.
So then you say, okay, past 2025, 2026, 2027. I like what you said about kind of getting past this hurdle
Hmm.
because I feel like, as polarizing as this election was, there, I think anybody with any sense of like intelligence knows that things are not going to be fixed tomorrow. I
Mm.
mean, it took us a long time to get into this mess. It's going to take us a long time to get out of this mess too. And
Yeah.
so there's going to be a period, I feel like, of growing pains and having to get through this to get to something better.
Yeah.
But I mean, you feel like if we keep moving forward, and of course, we can't determine what's going to happen in the world.
Yeah, now
There's a
you're
lot
the
there.
crystal ball thing is
Yeah.
really a hard thing to look down. And so this is what these economists and analysts do in my office a lot. I mean, we read everybody else's research too, and we look at different sectors that are going to grow in this side of the U.S. economy and ones that are going to pull back. But I do. I think America has had almost a 200-year history of always just being the leader in innovation, the leader of
Yeah.
actually standing up. I don't think that's going to change. I would like to see some of the other global players like China and India and even the UK, start taking a more pro business approach,
Yeah.
and that would be better for everybody inside of it. But I'm optimistic long term. I'm
Good.
not pessimistic, but I'm very concerned short term. We can't have stagflation. If we start having stagflation, we're gonna be in a problem. We're gonna have and it was to the point that if you listened, which I know if everybody wants to bore themselves to sleep, but I geek out over it. But if you listen to Powell's address that happened a couple of weeks ago,
Yeah.
he was asked twice about stagflation
Oh, really?
in the
Okay.
actual formal meeting by the press. And so that was like, it's not on just, us as analysts and us as financial planners in mind. This is starting to become,
Yeah.
a conversation around, hey, where's the economy looking like? Because we just can't have inflation coming back
Yeah.
up.
Well, and how did he answer that?
He said, will do everything possible to make sure that we don't have stagflation.
Huh.
Meaning, if he has to raise rates, then he will raise
Yeah.
rates. Because he's not going to let it creep back on there. So if we get inflation, that shows its head, substantial inflation. I'm not saying just 1 month's print like we
Right.
got, and then we saw a little bit of, but substantial inflation. I think he's going to raise rates. I don't think that's going to happen in the short term. It might happen in 2026, and we'll see. It's like, can we keep growing the GDP? Can normal businesses and small businesses still grow? And it's hard. I mean, housing right now is really hard.
Mm-hmm.
Construction is really hard right now. A
Mm-hmm.
lot of this is based upon rates. And
Yeah.
so I think rates will come down. I think you're going to be in the low sixes or high fives
Okay.
by this year sometime. I'm not this year in 2025.
Yeah.
But it'll probably be in the summer, which is great because the
Which is,
summer is the
yeah.
best time to
I
buy
mean,
houses or the highest peak
yeah.
time.
And I feel like, I mean, there was a whole group of people who they wanted to see who was going to be in office before they did anything.
Yeah.
Regardless of what rates did, they're like, yeah, I want to kind of know that's going to kind of tell me what I think my future is going to look like. And so they waited. But then you've also got that pool of buyers that always waits till the first of the year.
Mhm.
That's just what they do. And, like I said, nothing changed drastically after the election happened. We at least kind of knew
Where it's going to be,
right.
right?
And that was kind of that big answer a lot of people wanted. Um, but I think, yeah, people just want some kind of certainty to know, okay, at least kind of what am I looking at? But when you've got, I mean, I would be thrilled to have interest rates be in, at a 6% or even in a high five, because that's still a healthy rate.
Mhm.
You still have people who bought houses at a 7+ rate. I had some at 7.5 at some point. They can still refinance and bring their payment down a lot.
So I think that's a key point that what you're alluding to and you're getting to right there is really trying to understand the behavioral economics of where the consumer's buying a house. And I always look like this because I always get asked this question: should I buy a business? Should I buy a house? Should I do these things? And again, it depends, right? But to help people process what that should look like is just do the math.
Yeah.
Right. And so I'm the more conservative one. So it shouldn't be more than 30% of your AGI or your adjusted gross income inside there. I think some of it's like 40 or 50% in
Oh,
industry
yeah, you can get
ashes.
up to 49%
Yeah.
on 57% on FHA.
Yeah, and
Yeah.
so but is that realistic, right? And so this is why I think you should buy a house if you can afford it, but always look at the option of buying below your means. I think some of the success, even me personally, I look back at it as I bought a house well below my means and I stayed in it for over 12 years.
Yeah.
And it allows me to save capital to go buy the next thing, go to buy the next thing. And I ended up buying rent properties, went and did other things and grew wealth that way. And I think the keeping up with the Joneses is a hard thing not to do.
Right.
And that's where I always cautions people is you don't, at the end of the day, I mean, I got a client that has a 30,000 square foot house and he goes 2 years later after building it, it took 4 years to building it. He goes, you don't even notice it anymore. Right.
Right.
So I think refinancing is the key to option. So if you're paying a higher rate today, does it really matter? No. I mean, we pay a couple of $100 or a couple of $1,000 more in interest for a year, 18 months, but you're always going to find the time to be able to refinance it.
Yeah.
And so I think really making sure that it fits what your plan is, and if you have value, if that's the value that you want to place on your monetary value that you created through your human capital is buying a house, which I do. Everybody does. Everybody likes that nice house that you
Yeah.
live in, likes the nice car that you drive. You know that's kind of where you're just going to put your value in that. Okay, let's allocate it. Let's make sure it's right. But that means you need to give on eating out a little,
Yeah.
right? Maybe it's 2 vacations, not 3, right? There's all these things that you're gonna have to set and put that plan together to make sure that it fits. And if you're paying a little bit higher, I mean, my mom bought her house. Their house burned down. It was with my dad. It was freak accident and completely burned down. And she was like, Brendan, I want the house and this is what I want. And she bought it at 5 and a quarter. I
Mhm.
mean, 7 and a quarter. I mean, at one of the highest times, I was like, it doesn't matter. Like, well, a year, 18 months, 2 years down the line, we'll just refinance it back down to a normal rate.
Yeah.
If you can afford it at 7 and a quarter, you're going to love it at five and a
Right,
half.
exactly.
You know
Yeah.
what I'm saying?
Yeah.
You just got a pay increase right
Yeah.
there from that side of
Yeah.
it. And so, and just be conservative. You don't have to buy the $500,000 house when
Right.
you really afford a 350.
Right.
And so that's the hard part I have is I'm less worried about what the rates are and what your payments are instead of buying a house that's overvalued. That's one thing. I fight clients on going, hey, the value of this house is not,
Yeah.
what you think it should be. So it's you're buying at the top of the market at the highest
Yeah.
dollar per square foot. That concerns me because you have to stay in that property longer,
Mhm.
right? Because you got
For it to make sense.
to
Yeah.
make sense, right? So
Yeah.
a lot of people don't understand it's between 6 and 8% of the purchase price when you go to sell it,
Yeah.
right? And so if you're on that perspective, so in the average appreciation of a home is what, 3.5% a year?
Yeah. This year, I think they'll probably be closer to maybe 1%, but a
Oh, wow.
typical year in Lubbock, I mean, pre-COVID and all that was like 3 to 4%
Yeah.
year over year.
And so if you have to stay in that house for 3 to 4 years just to break even
Yeah.
inside of it. So a lot of people don't wrap their mind around it is it doesn't cost you as much money to get into the property, but you can't get out of it.
Right.
And so when you get out of it, that's when you got to pay the closing cost and the realtor's fees. And I'm saying this in general terms, right?
Right.
You can get realtor fees cheaper, right? All these things can happen. Just how you can sell it yourself and eliminate some of the fees. So there's all kinds of stuff. I like using y'all though, because it's been, I think on what, 10, 12 properties that I've bought.
I think so. Yeah.
Yeah, I think 8 or 9 of them's been through
Mhm.
y'all.
Mhm.
It's just the system on how y'all do it is efficient.
Yeah.
And that's what I like. So the hassle's not there. It makes it a
Yeah.
lot more fun to engage inside of there. I like the digital aspect of it. So you
Mhm.
can actually
Yeah.
track y'all's online apps of what information needs to be provided. So, and I had to go through the same process,
Yeah.
right? Inside of there. I think a lot of people don't understand that is like when you buy properties, you can own up to 10 of them.
Yes. You can find in the secondary market, you
Yep.
can finance up to 10.
So
Yeah.
it's typically your primary residence
Right.
plus 9,
Mhm.
right? And then before you get into commercial.
Yeah.
And so the advantages of that is you can extend the amortization schedule up to 30
Right.
years
Mhm.
instead of a conventional commercial loan, which is 20, 15,
Yeah.
20 years.
Some of them balloons or,
Yeah,
yeah.
there's always different ones that
Yeah.
you can structure. So those are a lot of advantages inside of it. So if you're paying a higher rate today, doesn't mean that you shouldn't buy a house. I think what it needs to do is, does it fit your budget? Does it fit
Right.
your want and your needs? And then you got to back into that in the
Yeah.
right way.
Well, and I think that's a big thing. I think people have gotten so involved in the interest rate conversation of, oh my gosh, rates are so high, they're so high. are you look at the payment. It's more
Mhm,
affordability. Like, can
mhm.
you afford this?
Yeah,
And I actually have had several people ask me, can we go ahead and refinance on, if they've, and I've showed them, well, it's not that much different for you right now. So let's figure out what makes sense. At what point does it make sense for you to refinance? And I had one borrower, she said to me, she said, well, like, can you figure out any way for me to get my payment lower right now? And I'm like, well, did you file your homestead exemption? Because
mm,
let's make sure you did that, right?
yeah, absolutely.
But the thing is, I think sometimes it's not so much about the house payment, it's about the rest of their lifestyle
Sure.
too. And so when you've got people who've got, credit card balances super high or car payments that are super high, your house payment, if you can afford that, it's not the affordability issue of that. It's everything else you're spending money on too.
Yeah, and I have this conversation with a lot of clients, and it's the credit cards are a problem. And so there's been a bill floating out there that they're going to cap interest rates on credit cards now going at 10%. I don't think that will ever be passed, but there's that conversation that's
Wow.
been floating out there. So what I think is interesting inside of that is kind of what you glean into is what you're talking about is an arbitrage, a debt arbitrage is if you can look at and say like things that we've had conversations with clients on is they have a whole lot of built up equity in their home, but they have $50,000 worth of credit card debt. You can do a cash out refi and pay a little bit
Hmm.
more, and you might be paying 7.5 or even 8, but it's way cheaper than paying
Right.
21%. You
Yeah.
see what I'm saying? Now the problem is you just got a safety net that wiped out that debt that amortized it over a 20 or 30-year period and you don't see it anymore,
Yeah.
or it's a lot less. Are you going to make the same mistake twice?
Right. Yeah.
Right. And so I always am cautious to make that recommendation to people with the caveat like, we don't need 7 credit cards. You want one, put it on the top of your refrigerator as an emergency thing like that. And let's just not have any type of debt.
Yeah.
And then put it all inside of there and pay off anything that's over there. But you got to look at that arbitrage on like, what's it cost me to pay this debt off compared to what this is. And typically, if it's, 50% less, then you're probably making a good call.
Yeah.
So, but to your point is that's why I really tell clients don't exceed 30% of their AGI.
Yeah.
Right. And that's a good starting point. If it ends up being a point or two higher, you're okay. If it's, I would prefer it to be in 25, then you're good because then the most expensive asset class, the most expensive asset you have is that your home typically, and then your retirement accounts,
Yeah.
right? And they could be both. The problem is you don't want to make that payment so high that life can't be fun anymore.
Right.
And then all you're doing is sitting at home and drinking some
Yeah.
lemonade and saying, "Very nice house.
Yeah.
Wish I could
Wish I
go
could go do
go
something.
to the
Yeah.
tech game or
Yeah.
something," right?
Exactly. Yeah.
And so that's the problem you run
Yeah.
into.
Yeah, that's for sure. And I think a lot of people, when they start looking at houses, they don't think about that.
Hmm.
And so that's when real life sets in after you've been in there for a while and you're like, oh, yeah, this isn't as fun as I thought it. Because it wears off.
It
At the
does.
end of the day, it's a car, it's a house.
Yeah.
Yeah.
It does. And
Yeah.
that you know, feeling of getting something new,
Yeah.
you
It
know,
wears off.
wears
Yeah.
off. Trust me, my wife has an obsession with very expensive
Yeah.
purses. And, she works so hard for the firm and for me and all
Yeah.
that other stuff. I'm like, you go get those purses. And she sees value on those things. But I'm like, you know, 3 months later, 6 months later, and I'm like, do you still like it? She
Yeah.
goes, oh, I still love it. Is it as nice as what you paid for it? No,
Yeah.
it's never. The answer is always no.
Yeah. It's
Right.
just carrying your stuff.
Yeah, it's
Yeah.
just carrying your stuff.
Yeah.
But a lot of people have different
Yeah.
different deals. I'm a big
For
tech
sure.
guy. So I mean, I sit here with your tech guys and we talked about camera gear all the
Yeah.
time and stuff like that. So I
Yeah.
see a lot of value in things like that. So it's really just where your value's at.
Yeah. Yeah. No, I totally agree with that. Well, you talked a little bit about optimism and you do what I like is you kind of giving a realistic, because I think that's what people want is they do want some hope.
Yeah, of
They
course.
do want to feel like that, oh, this isn't going to be hard forever, which, because I feel like in my industry, I don't know how it has been for you, but it's been a hard 2 years. And, done
Yeah,
good, but it's been a hard 2 years.
yeah. I mean, the market's really done good. The uncertainty is what makes it really, really hard. I think people have gotten just out of perspective on what the expectations
Yeah.
of what in my world is what they're on. So I will tell everybody right now that cash is king, preserve cash.
Preserve cash.
Yeah. And so make sure you have at least 3 to 6 months, preferably 6 months or a year worth of savings set to the side because it's not so much that we're in a downturn and I need to use that to live off of. Yeah. I always look at it like if you have a lot of capital set into the side, then you can take advantage of a good opportunity. But if you have no capital set to the side and a good opportunity comes across your table, then what are you going to do? Right. And so a lot of people either go out of business in a downturn, weather a downturn, or you can take advantage of a downturn.
Yeah.
And so I'm trying to teach a lot of people, let's take advantage of a downturn. You don't have to make 20% returns every single year. You can be okay with, you know, a good analogy of this is like if you had $100,000 and you lost 10% in the market, how much money would you have?
90,000.
Okay. And you made 10% the next
Right.
year. How much would you have?
You'd have back your other
100 grand,
yeah,
right?
Yeah.
Yeah. The math's not actually that way. So if
Okay.
you had 100,000 and you lost 10%, you'd have 90 grand.
Right.
But if you gained 10% on 90 grand, you would only have
Oh,
99,000,
Yeah.
right?
Okay. Yeah.
And so that's where a lot of people don't.
Ah.
And so your 2-year average of return is 0, but you never got back to even.
Mm.
Does that make sense?
Yeah.
And so when I talk to a lot of clients, I'm like, you don't have to capture 100% of the upside. What you don't want to do is capture 100% of that downside.
Yeah.
And so if we do have a recession and we see a pullback at 30, 40, 50% in the stock market, which is there's good evidence that might happen. Okay. I'm not saying it will. I'm not trying to be a dooms gloom guy, right? I still think there's great growth in the US economy. I just think valuations have gotten stretched. And if you want to be a little more conservative in the fixed income side of the house, in the bond market, there's actually good value there right now.
Yeah.
So you can actually rotate your portfolio. You can rotate your savings. I mean, I don't know what, 5, 10 years ago, buying a CD or buying a treasury bill was kind of like a laughing stock. You got like maybe 2%.
Yeah.
You can get some, really good, safe floating rate assets out here at 5.5 to 6% right now.
Mm.
And so, and those are liquid and they're savings and they're making good money off of it. So that's where I'm saying that you really need to look at and say, let's take some chips down, take them off the table, and let's put them in our back pocket here and save it for a rainy day if a rainy day happens. But really, if there's an opportunity, because you might find that dream home that you're looking at buying, and it might be somebody else that didn't take that advice and they're in a distressed situation and they have to sell.
Yeah.
And they have to sell. I mean, go look at Florida right now. I think the
Yeah.
average home prices in Florida are down 30, 40% since those hurricanes and since the insurance debacle and everything on there. So, I've had 2 clients come to me and buy homes in Florida over the last 3 months.
Yeah.
And they're buying them at like 50% of their value from 2 years ago. So it just value is relative. And you got to remember that it's what you value as a person and then also what the value of the market values it at. And when you can see value from something that nobody else sees is when you become wealthy.
Yeah.
And make sure you set that long-term goal, but it really is short-term. Hey, in 6 months, I want to do this. Or in 1 year, I want to do this, right? And keeping those wins, stacking those wins up so you don't have to work 25 years just to get the payoff of, oh, I've made it. I'm now retired, right?
Yeah.
I think we don't even use the word retire anymore in our office. It's just do what you want, not because you have to, but because you want to.
Yeah.
That's out of it.
Well, okay. One thing I did want to ask you too was, I feel like your line of work, even my line of work, it's a very trusted position. And there's can be a lot out there. It's a little scary in the financial planning world of who you work with, even in the mortgage world. So how do you or what's the best advice you have for someone who's wanting
when you're
to,
interviewing a planner?
Yeah.
So that's a great question. And this is one that I always look at. First, you just got to ask them, are you straight up at 7 and 66 or 7 and 6?
What?
Do you have a 7 or 66 series license?
Okay, license,
right?
Yeah.
Okay. And the 7's not as much as anymore because that just says you can trade stocks, right? That 66 or 65, when I say that, is the 66 just combines 2 licenses together. The 65 is the actual fiduciary license that you're actually charging for Avise. And by doing that, you are operating as a fiduciary. So you're bound by the agreement of the SEC and FINRA that governs us to make sure that you're giving complete, transparent advice and you're telling them all the upside and the downside, and you're making sure that you're not doing it for a fee, right? So you have to disclose all your fees. You have to go and everything's transparent inside of it. So ask, is your advisor a 7 and 66 or 7 and 65? If they're a 6 and 63, then you really have to understand the commissions because that means they're just commission-based advisors. There's not a bad thing about that. I'm not dogging on commission-based advisors by any stretch of the means. There's some really great ones out there. I got some really good friends that are commission-based. But they just gotta make sure that they're there to get a commission, right? They're not there to make sure you have success. So for us and our firm, we're there to make sure you have the most amount of success for the limitations of how much risk you wanna take,
Okay.
right? And we get to participate to a certain degree because ours is just a fee over what you want, what you make. So as your account goes up, our fee, typically 1% goes up with it, right? If your account goes down, guess what? We
Yours
get a
goes down too.
yeah, we get a pay cut,
Yeah.
right? And so those type of advisors are set on the same side of the table as what our clients are, and we align better to making sure that they're successful inside of there. And we're just not churning, hey, buy this, buy this, buy this, buy this, and just throwing a lot of products in front of them. Second is you need to make sure that you ask, do you have the sophistication in line with what you want?
Yeah.
Okay. And so it's some guys, some clients, they want it very simple, right? And then some people want the most advanced, hey, high level you get. And you got to align. And this is more of a, a relationship kind of side of it on how you communicate with your advisor. I got some guys that I'm analytical and so I like to explain things. They like that. And I have some people, typically the older ones that say, Brandon, slow down a little bit.
Yeah.
I have the trust with them, but I have to go through it a couple
Yeah.
times to simplify things down. And that's what I love. I love that challenging back.
Figuring out
Yeah,
who
because
you're dealing with.
I can't read you all the time,
Yeah.
right? Right. I go through my days. I see 4 to 5, 6 people on a daily basis, 3, 4 days a week. And sometimes I'm human too. You sat in a room and I just didn't read that you didn't
Yeah.
connect,
Mhm.
right? And so the ones that really frustrate me are the ones that just don't say, hey, Brandon, I'm lost. I didn't get it, right? And maybe I had a bad day, right? Or the advisor had a bad. It doesn't matter. Just communicate in a way like, I don't understand why this fee is here. I don't understand why the performance is this. I don't understand what's going on. And do they have that support staff around?
Yeah.
Right. That is the biggest thing inside of there. And look for the trust side. I always say if you constantly have to, the guy's trying to explain things at a level that's so high to make himself or the person make themselves look like they're
Yeah.
knowledgeable,
Right.
right? That is kind of a gap.
Yeah.
Okay. I will come in and say, okay, here's the technical side of it. Here, like we talked about debt to service coverage ratio. Here's what it means. Here's how it applies to you. Right. And when you're distilling that down like a teacher,
Mhm.
right? An
It
educator.
is an education
Yeah,
process.
it's an
Yeah.
education. And then you get a plan together and you can adhere to those plans and they're checking in with you when they're not trying to sell you something.
Right.
And so if they're only checking in with you to, hey, we got another sale, that's usually when a financial advisor or a registered representative
Yeah.
is kind of slanting some of the ways that they're doing it. And it's a lot harder today, but I still find them all the time.
Yeah.
You know what I'm saying? It's
Yeah.
and it's just a lot of trust to be built. And the trust comes with just the privacy statement needs to come out early. I think that's another thing you need to ask for. Hey, what's your privacy statement look like? Are you going to disclose my information? Right? Make sure it stays between us. Do you have redundancies built into your financial plan? Like if I got hit by a bus, we manage hundreds of millions of dollars worth of assets
Right.
with many, many clients. How does the firm keep operating? And so, like all of my meetings, I'm fortunate now we've grown a practice where I have a paraplanner in every single meeting I'm in. And so that takes all the notes and we deliver the actual financial plan or the concept of that meeting within 48 hours. And so the client knows, oh, I forgot this. Oh, and they read it and they renew their mind to it.
Yeah.
And it makes the process a lot easier because it's easy to go back to, hey, what did you retain in the last meeting
Right.
we were in?
Yeah.
That-
And I feel like anytime I have met with you, you've done a great job at that.
You have to.
Yeah, you
It's
do.
crucial.
Because
You-
I'm certainly not going to remember.
Yeah, yeah,
I mean,
you've slept since then, right?
Exactly.
That's the
yeah.
whole thing, and so have I. I mean, hundreds of clients inside of there, and we've gotten so efficient with the AI and Loom and things like that, where we're now actually recording ourselves talking for like 5 minutes about a case along with our written notes, because I actually get to see the nuances of me and my team to say, oh, this is what that client was trying to do. This is what we're doing. And then we go see them again 2 months later and we can renew our minds really, really
Yeah.
quick. So those efficiencies makes the time with the client better.
Yeah.
Right. Cause I don't I can help a client out faster, and I can get them to fill the gap of where their knowledge base is and what they want to accomplish quicker, right? And then we can have deep conversations, really fun, deep
Yeah.
conversations on what's the right solution. And that's really where it gets really interesting.
Well, I think that you do a fantastic job,
I think
and I just appreciate you being on here.
I do. Yeah.
And
Thank you for having me.
so tell people where they can find you.
Yeah, so the firm's called Alpha Capital Strategies. We're off at 98th in Milwaukee. And we have a podcast as well. It's called Pursuing Alpha. I think you're supposed to be on our podcast. Like we're
Soon.
fixing to,
Yeah.
invert this thing around, which I think is going to be a lot of fun too, because I get to grow you a little bit. But so you can follow us on Pursuing Alpha, right?
Okay.
And the firm's called Alpha Capital, and the phone number is 806 300 0401.
Awesome.
I
Are
appreciate
you
it.
online? Are you on social media?
Yeah, the firm's on social media. Inside of there, I don't.
I'll find your handles and I'll tag them.
Yeah,
So,
tag them
okay.
inside there. That's Orion.
Okay,
Yeah,
yeah.
Dylan there. But I think it's Pursuing Alpha is our
Okay.
handle.
Awesome. Well, thanks for being on
I
here.
appreciate you so
Yeah.
much. Thanks for having me.